This week, the Australian share market had one of its roughest stretches in months. If you opened your phone and scrolled through any finance page, you probably saw the same thing I did. People talking about losses. People talking about pulling their money out. Genuine panic in some corners. But here's something interesting I noticed while going through the data for this video. There's always a small group of investors doing the exact opposite during weeks like this one. While everyone else is selling, they're quietly buying. And when you actually look at history, that small group tends to come out ahead again and again. So today I want to show you why that happens, the psychology behind why most of us get this instinct completely backwards, and what the data actually says about moments exactly like the one we're in right now. And stick with me, because later in this video I'll show you exactly where some of that opportunity might be sitting right now, in sectors that have honestly been beaten down the hardest. Hey guys, Daniel here. Welcome back to Daniel Reports. If you're new here, this is where I break down money, markets, and the economy in Australia in plain English. No hype, no jargon. And before I go any further, let me be upfront about something. I'm not a financial advisor, and nothing in this video is personal advice for your specific situation. What I am going to do is walk you through the actual history and the psychology behind this topic, because I think it's genuinely one of the most misunderstood parts of investing. If that's the kind of grounded, honest content you're after, do me a favor, hit subscribe, tap that like button. Takes 2 seconds, genuinely helps this channel keep growing. All right, let's get into it. Let's start with exactly what's been happening, because this isn't some abstract example. This is happening right now. The ASX has actually slipped into negative territory for the year after a broad-based sell-off hit the market hard. Analysts are watching a key support level, and if it breaks, some are warning the decline could stretch further from here. I want to be clear, this is a real current sell-off, not a hypothetical scenario I'm building for this video. So the question I actually want to answer today is, why does almost everyone react to weeks like this the exact same way, and why is that reaction usually the wrong one? Quick pause here, because I know some of you are thinking, all right, Daniel, isn't selling during a downturn just common sense, protecting what you've got? Stick with me, because the next part is going to challenge that instinct a bit. Let's talk about why our brains handle this so badly, because honestly, it's not a character flaw, it's just how we're wired. There's a concept in behavioral finance called loss aversion. In simple terms, losing money feels roughly twice as painful as gaining the same amount feels good. So when your portfolio drops, your brain doesn't process that calmly. It reacts like there's an actual threat, the same part of your brain that handles fear in general. Here's a daily life example that makes this click. Imagine you're walking down a street, and suddenly a group of people start sprinting past you, clearly panicked. Even if you have no idea what they're running from, your body's first instinct is to run too. Nobody stops to check if there's actually a fire. That's basically what happens on a trading app during a sell-off. Red numbers everywhere, other people selling, and your brain screams at you to join the crowd purely because everyone else is moving. Now here's where it gets genuinely interesting, because when you actually look at the history of markets, that instinct has consistently been the wrong one to follow. Looking back at major bear markets, the S&P 500 has historically risen by an average of around 47% in the 12 months following the bottom. Let me give you a few specific examples, because the average alone doesn't tell the full story. After the 1982 bottom, the market rose 57% over the following year. After the 2009 financial crisis bottom, 68%. And after the 2020 pandemic crash bottom, a genuinely massive 74%. Here's the part that I think most people miss completely. Those strongest gains almost always happen before the official good news arrives. Before unemployment improves, before confidence surveys turn positive, before the headlines start saying the worst is over. By the time everyone agrees things are fine again, a huge chunk of that recovery has usually already happened. So the people who waited for certainty, waited for the headlines to turn positive before buying back in, historically missed out on a genuinely significant part of the recovery. Now, I want to be honest with you here, because I don't think this video does its job if I just tell you this is easy. It's genuinely not. When the market is falling, every single headline you see is negative. Every conversation with mates is about how bad things are getting. And buying into that environment feels completely counterintuitive, because your entire nervous system is telling you the opposite. My honest take on this. I think most people who say they'll buy the dip when it happens actually freeze up completely once it's real, because in the moment, it genuinely doesn't feel like an opportunity. It feels like danger. That gap between what sounds smart in theory and what actually feels possible in the moment is exactly why so few people manage to pull this off consistently. So let's bring this back to what's actually happening right now, because this isn't just a history lesson, it's relevant this week specifically. During the current sell-off, some analysts have pointed out that certain sectors have been hit especially hard, uranium and travel stocks among them, to the point where some of these names are now sitting in what's considered oversold territory. Now, I want to be really careful with how I frame this, because this is not me telling you to go buy any specific stock. That's genuinely not my place, and it's not what this video is about. What I do want you to take away from this is the pattern itself. When broad panic hits a market, it doesn't hit every company evenly. Some genuinely strong businesses get dragged down purely because of sentiment, not because anything about their actual operations has changed. That gap between a falling share price and a company's real underlying value is exactly where historical opportunity has tended to sit. All right, so if buying during a crash is so psychologically difficult, what's the actual practical way to approach this without needing perfect timing or nerves of steel? The answer most experienced investors actually use is something called dollar cost averaging. In plain English, that just means investing a consistent amount on a regular schedule, regardless of whether the market is up or down that particular week. Here's why that approach genuinely helps. It completely removes the need to guess the exact bottom, which honestly nobody, not even professionals, can reliably do. When prices are down, your regular contribution buys you more. When prices are up, it buys you less. Over time, that evens out without you needing to make a single high-stakes emotional decision in the moment. Here's a way I think about it that makes it click. It's a bit like filling up your car with fuel on the same day every week, rather than trying to guess the exact cheapest day at the pump. Some weeks you'll fill up when it's expensive, some weeks when it's cheap, but you never end up completely stuck without fuel because you were waiting for the perfect price. I want to say clearly again, this isn't a recommendation to invest a specific amount in any specific asset. This is a general concept, and how it applies to you depends entirely on your own financial situation, your goals, and your risk tolerance. If you're unsure, that's genuinely a conversation worth having with a licensed financial advisor who actually knows your circumstances. So what does all of this actually mean for you, sitting there right now, watching your own portfolio move around this week? If you're already invested and you're watching values drop, the historical pattern strongly suggests that panic selling during moments like this has usually hurt long-term investors more than it's helped them. If you've been sitting on the sidelines waiting for the perfect moment to start, understand that waiting for certainty usually means waiting until after the biggest gains have already happened. And either way, having a plan you can actually stick to, rather than reacting emotionally to whatever the market did this particular week, tends to be what separates people who build wealth over decades from people who get shaken out at exactly the wrong moment. Let's bring this all together, because I know we've covered a lot of ground. This video isn't telling you markets never fall or that risk doesn't exist, because it absolutely does, and past performance is never a guarantee of what happens next. But what history does show pretty consistently is that markets fall and markets recover, and the investors who understand both halves of that pattern tend to end up in a much stronger position than the ones who only ever see the falling part. Here's my honest take to close this one out. Being a smart investor isn't about being fearless. Everyone feels that same instinct to run when the headlines turn ugly. It's about recognizing that instinct for what it is and having a plan calm enough to make decisions with your head, not just your gut, especially during weeks exactly like this one. If this changed how you're thinking about what's happening in the market right now, drop a comment and let me know. Are you buying into this current dip, or are you sitting back and waiting to see what happens? I read every single comment, and I genuinely love seeing where everyone actually stands on this. And if you know someone who's been panicking about their portfolio this week, send this video their way. Sometimes a bit of historical context is exactly what someone needs to avoid making a decision they'll regret later. I'll keep tracking how this current sell-off plays out, because if history is any guide, this might end up looking very different in hindsight than it does today. Hit subscribe if you want grounded, honest breakdowns like this one instead of panic-driven headlines. I'm Daniel, this has been Daniel Reports, and I'll see you in the next one.